Good morning to Americas, good afternoon to Europe, and good night, whoever is still on from Asia Pacific. It's my pleasure to kick off the third block and the third session. I have to thank again at this stage the tremendous work what the Lecky Group and Omfif did so far for all the organization, the high quality impact speeches, and also panels we could listen over the past 6-7 hours. And we will follow here the next 2.5-3 hours for the third block of Americas. Having said that, it's my pleasure also to say a big thank to our partners here, Union Investment, Morningstar, and in particular Deloitte. And if I say Deloitte, it's my honor here to welcome and quickly introduce Robert Contry. Robert is same as me, a developed market member with more than 30 years experience, may I say so, Bob? And he can refer to many, many happenings in financial markets, crisis, and also positive segments. Unfortunately, we have the pandemic ongoing for exactly a year now, but also here we have learned our lessons. And I believe when I see the latest political development in America, there's a lot of hope that the Biden administration and all its related entities will play a different contribution to make this a better sustainable world. But having said that, coming back to Robert, Robert is heading the global financial services among Deloitte, which includes more than 70,000 employees. Wow, that's a big job, Bob, and I'm not jealous on that, I have to say, and this in more than 40 countries. I do hope I can welcome you in person here in Germany and in Frankfurt soon, but as it looks like we have to wait at least for the springtime, probably even early summer on that. Yeah. Bob, I'm very eager to learn more, and I guess as well all our listeners, what can you tell us about the latest activities of Deloitte? What have you done throughout the pandemic, and what is your forecast for the future? Please.
Well, thank you, Frank. And I as well am looking forward to the day when we can start traveling again, and I would welcome the opportunity to see you in person in Frankfurt. I was fortunate enough a week ago to get the first of the 2 vaccine shots, so I'm at least on the way to starting to travel again. But I'm really pleased to have the opportunity to join you all today. So hello, everyone, and welcome, as Frank said, to the America's version of the Global Roundtable Sustaining Momentum Conference. So during this time, over the next couple hours, we're going to hear from a great group of experts on a number of topics, including the future of sustainable finance in our region, the Americas, and also the Americas' role in the pursuit of global net zero emissions. I thought I'd spend a couple minutes introducing these topics and sharing some thoughts from my perspective and my platform at Deloitte. So clearly, sustainability is the crisis of our generation. It's not possible to live sustainably if we erode and deplete our capital, whether it be economic, social, or environmental. Some of you may have heard my partner, Hans-Jürgen Walter, who is our financial services global sustainability leader, comment earlier on the work we've been doing with the IIF, the International Institute of Finance, examining the role of the Chief Sustainability Officer. The financial services industry sits firmly at the epicenter of this crisis and has a unique perspective and role to play with both the risks and the opportunities emerging from the sustainability challenge. Not only are financial services firms exposed to physical, transition, and liability risks from climate change, but they also need to be critical players in transitioning the global economy to a low-carbon reality through the mechanisms of sustainable finance. Climate change as a structural long-term crisis needs major private and public investments to transform the economy to deliver the environmental and social sustainability goals. And sustainable finance is the mechanism to implement these strategies for achieving, ultimately, a carbon net zero world. Now, I recall that stakeholders for a cohesive and sustainable world was the theme of the 2020 World Economic Forum event in Davos last January. And that was actually one of the last in-person meetings that I was able to attend before the pandemic took control. It was amazing how in that one meeting we heard the conversation shift so comprehensively from the status quo, business of business is business, to one much more focused on purpose beyond profit. So clearly, climate change was the theme at Davos in 2020. Many of the CEOs of the world's largest companies now expressly support aligning around a core set of metrics and disclosures on the non-financial aspects of business performance. It started with an amplification of sustainability and climate concerns at Davos, and now has become top of mind in all areas of industry, business, and government, especially as the COVID-19 pandemic has engulfed the world. The pandemic is changing the world, the way we live and work, what we prioritize, who and what we trust, and a recognition that there are structural inequities and existential crises that we need to deal with as a society. Until recently, I would say sustainability and climate received significantly more interest from the UK, Canadian, and EU financial institutions than it did from regulators and market participants in the US. However, over the past year, we've seen a steady increase in US regulatory and supervisory activity to analyze climate risks and assess the potential impacts on global financial stability. Prior to the Biden administration's environmental protection and regulatory push, corporations had been the driving force behind sustainability in the US. In August 2019, over 180 CEOs of America's largest corporations redefined the purpose of a corporation from solely maximizing shareholder return to also delivering value to their customers, investing in employees, dealing fairly with suppliers, and supporting the communities in which they operate. All sustainability goals. Hurdles to sustainable investing, such as the US Department of Labor's retirement investment rule, which hampers asset managers' ability to use ESG disclosures along pure financial returns, will also likely be addressed as the new administration focuses on sustainability guidelines and policies. Another key indicator clearly is the new key indicator of President Biden's focus is the signing of the executive order on January 20th to re-enter the Paris Climate Accord. On the regulatory front, it's quite stark to look at the difference from 2 years ago when the San Francisco Federal Reserve Board's publication on monetary policy implications of climate risk to its publication in February 21 on climate change. And we're seeing an increasing acceleration in US regulatory activity. Some more examples, the CFTC established a climate-related market risk subcommittee. The Federal Reserve Board hosted its first ever climate risk conference in November 2019. The SEC's Investor Advisory Committee is approving a policy document related to ESG disclosure in May 2020. The New York DFS, Department of Financial Services, expecting insurers to begin integrating climate-related risks into their governance frameworks and risk management processes as of September 2020. The FRB announcing it had formally joined the network of central banks and supervisors for greening the financial system in December 2020. Treasury Secretary Yellen proposing new efforts by the Treasury to address climate risks in the financial system during her Senate confirmation hearing just last month. And the SEC appointing a new senior policy advisor for climate and ESG in January 2021 as well, just last month. So clearly, in summary, the sustainable finance market has seen rapid growth across the globe during 2020, partly in response to the global pandemic, as well as ongoing sustainability concerns. In the Americas, social and sustainability bonds smashed the previous records for amounts raised, while green bonds hit new high and sustainable companies issued record levels of equity. In 2020, the issuance of social bonds reached a record 164 billion, a figure nearly 10 times that of 2019. Over the same period, sustainability bonds also increased to 128 billion, 3 times that of 2019. Equity issuance from sustainable companies in 2020 increased by 65% to a record 14 billion, with the Americas dominating sustainable equity finance markets with a 77% share. And finally, while overall in terms of value, Europe continues to dominate the market for new sustainable finance products with a 48% share, the Americas with a 28% share is seeing rapid growth. In the Americas, with the world's largest capital markets, the potential exists to exert much greater influence on the use and provision of sustainable financial products. And market participants in the region seem already to be leaning decisively towards sustainable options. Just a few more examples. 26% of the $12 trillion in U.S. assets under management were held in sustainable vehicles at the end of 2019. In Canada, this number jumps to 51% of the country's AUM. And in both countries, green bonds form the majority of sustainable financial instruments. Let's just take a look for a second at some examples of investor sentiment as well in the Americas, based on a recent study by a large global bank. 53% of investors in the Americas believe they have a responsibility to avoid investments that might have a bad effect on the environment or society. 63% of investors believe they can improve performance with sustainable products. And further, 71% feel a responsibility to consider environmental, social, and governance issues that might affect investment performance. So investors in the region also make an association between their practices and the wider economy. For example, 36% of investors agree that achieving prosperity and a healthy, secure life for all, as outlined in the U.S. Sustainable Development Goals, is critical for the success and stability of their economy. This sentiment is high and growing in the U.S., with 39% of investors agreeing, whereas the global average is only 28%. These indications of market sentiment, policy and regulatory change, and societal expectations suggest that America's capital markets are geared to drive the changes needed. While the level of sustainable finance products currently in the Americas are behind the Paris Accord expectations, their use is growing rapidly. We're certainly going to see a lot of moving parts as the financial services industry gears up to drive the changes needed to achieve a net zero emissions world. As we will hear from our keynote, Mr. Roy, and the two panels that follow, this is a focus for all of financial services across the Americas. With that, I'm happy to pass this back to you, Frank, to introduce our keynote speaker, and thank you again very much for your time today.
This is very great that we could listen to you, Bob. Impressive statistics and numbers, and I'm pretty sure we will hear more from the US and North America throughout this years. As far as I know them, they will start again to lead the track towards to a sustainable tomorrow and hopefully a carbon-free globe in 2050 latest. Having said that, again, a big thanks to Deloitte. Thank to you, Bob, and also to Hans-Jürgen Walter, who without him it wouldn't be happen. I have to thank him, and he's a great partner having him here in Frankfurt, responsible for the German-speaking rim in Europe. Having said that, I want to turn back let me say it's a true global approach. As I pointed out earlier, we have started in the Asia-Pacific rim, went to Europe, and now we are here in the American continents. And I have the pleasure, a long-term friend is coming up now, Jingdong Hua, the treasurer of the World Bank Group. He has a responsibility. He's not of minor to what Robert had on his shoulders, probably even more heavy, given the fact that Jingdong, he has to fund with his excellent teams and stuff, more than $70 billion every year. This under the names from IBRD and obviously the famous IDA, which, if I remember correct, Jingdong, a couple of years ago, on an introductory speech in London, I created for you a new asset class, giving all the money who's in the pot AAA+, right? Yeah, and well, let me come back. Let me come back to Jingdong. He served before as well in a similar function, vice president and treasurer of the IFC. And I knew him as well from the past when he was serving at the ADB in Manila. who had the opening and this morning as an institution. And so he is a true global citizen with a lot of knowledge. He has seen everything in markets, what you can imagine. But I have to say, he's also an entrepreneur. Probably it sounds a little funny calling a treasurer of such an important official institution entrepreneur. Why do I say that? Jing Dong also at the IFC side, he was developing local markets in emerging markets, and which is not a give and take. You know, the burden for developing countries is often that they have to run against these strong currencies like the US dollar and others. And here he made a challenge and a difference. And it is also after his leave continuing path the IFC is following. And what I have seen the years since he is now in charge at the World Bank Group, he is coming up also from the dominance of the US dollar. He's trying to use other currencies with pleasure as well on the Euro side, but as well as I hear and see that you have other currencies in mind. And I can just say we will stay on your side as many others of our competitors. And I keep my fingers crossed that you can follow that as well at the World Bank, and we can help these developing countries to have a chance to pay back their debt at one day. And this also if they have access to local market funding. Jing Dong, the floor is yours. Thank you very much for joining us. My pleasure.
Well, thank you very much, Frank, for that very kind introduction. And good morning, good afternoon, and good evening to colleagues who have joined all over the world. Let me thank DZ Bank and Omfif for this wonderful event, the Follow the Sun. This truly reflects the global nature of sustainability. And thank you for the opportunity for me to share some of the things we do as a World Bank, and especially as a World Bank Treasury, where we are using innovation, and we are using our AAA franchise name to connect global savings to our efforts in fighting the devastating effect of the pandemic. So let me start by just describing a little bit of the impact of the pandemic. Look, the World Bank was created after the Second World War. I think in the past 7 decades, the World Bank has helped over 100 countries in many different crises, be it human, natural, civil war, and but this pandemic is quite different. That for the first time in many decades, we have now seen the steady progress that we have made in reducing poverty has been reversed. One of our research projections suggests that we are now saying by 2021. Additional 110 to 150 million people will have fallen into extreme poverty, and that is certainly a worrying trend. 1.6 billion children are out of school, and although in the United States and in Europe, kids still can go to school virtually using a good Wi-Fi and technology, 1 billion kids in developing countries truly have lost access. So this is really, really devastating. And if we turn to the Latin America region, I think the damage is equally worrying. I think our prediction is the Latin America Caribbean region, excluding Venezuela, economic growth is actually will decline by 7.9% in 2020. And because of the pandemic, as a matter of fact, 6 of the 10 emerging markets and developing economies with the highest COVID-19 deaths per capita globally are in Latin America, including 5 of the region's 6 largest economies. So this is really an unprecedented event. Now, I feel very privileged to be at the World Bank when the pandemic hit, and working with our board, which is representing virtually all the countries in the world as shareholders. The World Bank quickly came up with a $160 billion package to help more than 100 developing and poorer countries to fight the devastating fallout from the human social economic damage due to the pandemic. And I'm very happy to say that up to now, of the $160 billion, over 60 billion have been approved and are being dispersed, helping over 300 projects in over 100 countries, helping those countries fighting the effect of the pandemic. Just to give you a couple of examples, in Latin America, we have a project in Argentina that is helping the country to prepare for, pandemic patient isolation and patient care. In Mexico, we provided a loan of $1 billion in support for continued access to finance for small business, because small business has been devastated, and they are really the engine for job creation. In Ecuador, we have a project about $500 million for inclusive and sustainable growth. In Peru, there is a $50 million loan to ramp up investment in human capital. So all of these projects really require funding, and this is where the work that we do at World Bank Treasury is critical, because we provide the nexus between global savings and development finance. And just very simply, the World Bank Treasury, since our first bond under the IBRD name in 1947, we have just crossed the $1 trillion mark. That's the total cumulative bonds that we have issued in global debt capital market, which means that we have risk mitigated and transformed global savings, which otherwise would not flow to developing countries, but they were directed to projects in developing countries. As we have now passed the immediate crisis of the pandemic, the World Bank Group is very focused in helping countries to see how we can focus on supporting countries so their recovery becomes inclusive, resilient, and sustainable. And of course, all the global issues, whether it's inequality, climate change, gender, and others, should be a big part of it. And therefore, I think the sustainability theme is so critical to the global recovery, especially in developing countries. So I'm really happy that we have this opportunity to bring attention to this. As a World Bank Treasury, I think we have been issuing bonds for decades and decades, but it was in the early 2000 that we have noticed that there was a growing voice in using capital market to bring attention, but also bring financing to global issues, including climate change and other issues. And therefore, the World Bank Treasury was very happy in terms of being the first global institution that issued the first green bond in the world. At that time, that was 2008, we worked with a Swedish bank and Swedish investor who were at the forefront of sustainability and climate change. And as Robert introduced, from that point on, it's a small bond of several hundred million Swedish krona, to a market of labeled thematic bonds that has crossed $1 trillion. This really has demonstrated the power of sustainability sales in the sense not only to provide a vehicle, but also to bring awareness, bring global investor to support this global agenda. So the World Bank Treasury is not only about using our name to issue green bonds, sustainable development bond. It is also using our leadership role to make sure there is transparency, global standard, to bring trust, to bring a transparency into the market. So from the green bond label, we have now turned our attention to the much broader SDG bond, so that we can use our bond program to bring awareness, to bring focus to many different issues under the broad theme of sustainability. So maybe I can give you a couple of examples. One is, of course, a green bond, which we helped to create. Another is that, you know, I myself was educated through the process. So we were launching a bond addressing global food loss and waste. And through that process, I learned the food loss waste is actually the third largest carbon emitter after energy and transport. And due to the food loss and waste, 20% of fresh water is wasted. So, you know, when we went on roadshow in Japan, highlighting the impact, the devastating impact of food loss and waste, I was very encouraged that we raised a couple of $2 billion, and we had very strong investor reception. Similarly, we have issued bonds addressing gender, addressing ocean pollution, and addressing other SDG issues. So this is really something that we felt that the social bond, sustainable bond, has huge potential in terms of continue to attract and increased attention from global investors. As a matter of fact, I think the ESG inclusion in investment decision has now been mainstreamed. You know, we recently did a survey that showed that 85% of investors look at ESG factors as part of the credit risk process, and 91% of investors are sovereign debt managers for ESG information. So let me turn to Latin America a little bit on this. So in Latin America, we have been partnering with countries in the region to raise new funding for development needs and take advantage of investor demand for assets that support sustainability and transparency. For example, recently we worked with Colombia, where the government just received approval from Congress to issue thematic bonds. And we are very excited that we'll work with the government, share our experiences, and hopefully through the thematic bonds channel, the government Colombia can really connect with global savings and raise funds to fight climate change and other sustainability issues. And Robert gave some statistics. I also have some numbers to share that countries in Latin America have issued about US $7.6 billion in thematic bond issuance in 2020. The vast majority of issuances came from Mexico, Chile, Ecuador, and Guatemala, who issued either green social sustainability labeled bonds and providing investors with detailed information about their activities and positive impact. Now, talking about impact, in addition to the bond issuance, I think what we have done in the World Bank is really through our impact report, whether it's a green bond or our SDG bond impact report, to bring a direct connection between the fund investors given us to the transformation, the global impact that we bring through the projects that we do. Another topic I'd like to quickly mention is really the power of innovation in terms of being able to raise new funding. Here, the World Bank Treasury has been a leader in terms of green bond, thematic bond, the world's first blockchain bond, and we will continue to use our innovation to bring in new investors. One class of bonds that we feel that has huge potential is catastrophic bond, where we can use the power of the bond market to help countries to mitigate the devastating effect of natural disaster. It could be earthquake, hurricane, drought, so on and so forth. So for example, in 2006, Mexico became the first country to utilize a CAT bond. And later on, we have issued a CAT bond for the Pacific Alliance countries, Colombia, Chile, Mexico, and Peru. And last year, we also issued the first cat bond for the government of the Philippines, so that they can use cat bond to help them to mitigate the effect of typhoon and earthquake. The good thing about the cat bond from an investor perspective is that it is a fixed income asset that is uncorrelated with the traditional fixed income asset, and therefore there is a natural demand on the countryside, because many developing countries are already very stretched with their fiscal space. Therefore, when a disaster hits, the country really have no additional means apart from additional lending from the World Bank to have financial resources to take care of its citizens that suffer from the consequences of natural disaster. But with the cat bond, which is parametric, a payout will be triggered without additional burden on the country. This provides a tremendous new avenue to support the country to fight the effect of climate change. Let me end this section by saying that that innovation continues. Just today, the World Bank is very pleased to announce that we have issued a new bond, and part of the bond's proceeds goes to UNICEF, and that portion of the bond is backed by the future private donation from the many UNICEF supporters. And the other part of the bond is, of course, a World Bank bond, and the whole bond is issued and the under the IBRD name. We're very excited because this is yet another innovation where we can use the power of global capital market to front load very much needed development resources for UNICEF to help children in many developing countries because they suffer unproportionately during this global pandemic. And we will continue to use the power of capital market in raising more funds under sustainability, helping not only ourselves, but our partners in the world. So let me end by a reflection. Look, this global pandemic yet again showed the power of multilateralism. It is only natural when a disaster hit, and in this time, border is no protection. Every country is affected. The government of every country, including both advanced country and developing country, their priority is really first to serve their own citizens. And therefore, in Europe and in the United States, you have seen unprecedented amount of stimulus in supporting its own domestic economy and its own citizens suffering from the pandemic. But what about many countries who do not have that resources to help themselves? And this is where the World Bank, Inter-American Development Bank in our region, Multilateral Development Bank, the UN system, the IMF, our job is to help countries who cannot, raise finance on their own because they have a very stretched fiscal situation. And I'm very proud to work in a multilateral institution, and hopefully through our joint effort, we can raise awareness and really interest more global investors to come supporting development finance. And so with that, Frank and colleagues, I look forward to a very successful Latin America region discussion for this important topic. Thank you very much. Back to you, Frank.
Jingdong, thank you so much. Well, I have to say I'm proud about what you're saying, and for you, for your staff, and for all the countries and the people living in these countries, you be of help. And if I have called you before an entrepreneur, I have you more to call you the Elon Musk of the official institution market and capital and financial markets. Then, yes, if I may say so. It sounds great, and I'm personally looking forward to work with you and your colleagues on many of those ideas. I do remember the 90s, particularly the late 90s, when you mentioned cat bonds, and cat bonds were always a very special challenge, because to hedge the risk of a complex cat bond was nearly impossible, and we always had these Russian super mathematicians back in the back seats who helped us to price it, and I can really remember these times with the reinsurers, and so I know what you're talking about. But that leaves a lot of hope, again, that here, with the help of the World Bank Group and your related counterparts and contacts, you make the developing side a better one, and also after the pandemic is being solved hopefully soon. Again, big thank to you, Jingdong. And before I stop talking, I have to hand over, and I will hand over to a common friend, a very good friend, David Marsh, the chairman of Omfif. He is moderating two very important and also honorable person, I have to say. The one person is coming from the Washington, D.C. area, and Sarah Bloom Ruskin. I'm very happy that we could manage that she is as part of today's global sustainable conference and roundtable, and obviously she will take also a role, a very important role on that subject, sustainability, in the new Biden administration. We might have the pleasure to hear more from her. If not, then the press will hopefully release something over the next couple of weeks. Having said that, the second person is Ann Simpson. Ann is Executive Officer and Director of the Board of Governance and Strategy at CalPERS, based in California, Sacramento. So you see also in this huge country of the US, we playing the West and the East Coast, and being very honored to have Ann on board. And finally as well, Flora Chow, Global Head of Funding of the IFC out of Washington, D.C. And all of them will be moderated and probably a little teased by David Marsh. Before I hand over now, I also be very happy that the last moderator of the final panel at 4:20 p.m. Frankfurt time is Denai. She is running the SPI Institute of Omfif and is in charge as well for the chief economist position and director of research. She will have then a large panel to moderate. That's why it is a little longer. And then I have the pleasure to close a day after almost 10 days. Thank you very much. And let's enjoy David Marsh and the panel.
Good afternoon, everybody. Good morning, wherever you may be. This is David Marsh, and it's my pleasure to introduce the next session now in our American round. We've been kicked off very well, I think, with Bob from Deloitte, and now a very inspirational talk from Jingdong Hua, who's known to all of us as being a great ambassador for sustainability, not just in America, but around the world in his new job as treasurer at the World Bank. And it's very good, Jingdong, if you're still listening to this. I thought the way that you described the transition that the World Bank has made away from the purely green bond agenda through to the somewhat wider agenda of the Sustainable Development Goals, linking all that to your bond issuance, I think that sets a very nice tone for what we're going to be talking about now. Our title is The Future of Sustainable Finance, and we're looking at this from three different aspects, all linking in America. We're looking at it from the large political regulatory point of view. We're going to be looking at it from the viewpoint of one of the largest public sector investors in the world. and also from an issuance point of view. And to debate that with me, we have three very well-known people from America. May I just introduce them all in the order that they will be speaking. Sarah Bloom Ruskin, who's very well known to many of you. She played a very important role during the Obama administration. She was a member of the Board of Governors of the Federal Reserve. She was Deputy Treasury Secretary when Jack Lew was in place. She's been now a visiting professor at the practice of law and a distinguished fellow at Duke Law School's Global Financial Markets Center. She's got all kinds of experience in many, many different areas of finance. I've described her before as a Renaissance woman because she seems to be dabbling in everything. I don't know how she finds so much time to do all these things, Sarah, but it's a great pleasure to have you with us. It's so important, I think, that we have somebody like you who's very well connected to the new administration to talk about the wind of change that's blowing through America. We will be having shortly with us Anne Simpson, who again is a great force in this area, and she's the managing investment director at CalPERS, the Californian pension fund, with about $400 billion under management, one of the great forces in sustainable finance, and indeed ESG in general, because as I know very well, she's been on the governance side, the corporate governance side of investment for many years, has been a real pioneer in that area. She may be having a few difficulties connecting with us from California, but I hope very much that she'll be coming along to talk to us about the investment side of these things. And then Flora Chow, who is, again, a real éminence grise in this area, and of course is a person who's been working very solidly and very competently with Jingdong for many years at IFC. And Flora is the global head of funding at IFC. She also chairs this very important board of people looking at the whole sustainable principles for bond issuance. So she's very closely connected to the whole SDG area. And all three of you, I think, link in very many other organizations, not just the ones that you're involved in at the moment. And so really important, Sarah, to have you with us first. If I could just ask you to kick off and talk about the way that the Biden administration is making a difference to the multilateral approach towards sustainability. We've been used to Mr. Trump in the White House. Clearly, there was still a lot of coordination going on the regulatory side between America and the rest of the world. Where do you think the big differences will be in terms of sustainability and the financial markets approach to all this? Also, how quickly do you think the Americans will catch up with and possibly take over or overtake the Europeans in terms of your regulatory acumen? Because there will be a bit of competition here, I think. So great pleasure to have you with us, Sarah. Over to you.
Well, thank you, David, for that kind introduction, and it's a pleasure really to be here with OMFIF and of course all of the members. So thank you for raising this topic, and of course the title of the panel is quite telling. You know, sustaining momentum, right? And in the U.S., that notion of sustaining has a particular resonance because, of course, as you mentioned, David, the U.S. is lagging at the moment. So in terms of what we here on this side of the pond need to do is, I think, quite significant, and that is primarily because of these, I would say, these lost 4 years. And it really, when you think about it, just to put it in perspective, it was less than 7 months ago where on the US side, climate risk was actually not even considered a risk that had much of a linkage into financial markets and the economy. It was considered really just a kind of social good, a public product that was something that essentially was outside the realm of the regulatory agencies. And that wasn't long ago in the US that view was held. And it was held in part, I think, because of a climate denialism that was at the heart of the last administration. It was very hard for, I think, many climate scientists as well as climate economists, and certainly climate policymakers, to be able to even make the case that that we are in the midst of a climate catastrophe. So in the U.S., just to set, to set the stage here, there is lost time, and I would say a lost chance at leadership. Now, the good news is that with the election of President Biden, we have, in essence, a new opportunity, and you are starting to see in the development of science, of the acknowledgement of the linkages between climate science and financial markets, that there is an opportunity here to start to regain a sense of being at the lead in trying to tackle these problems. And so what you're seeing, and it's still early days, but you're seeing huge amounts of emphasis being put on climate in the White House. You have offices being stood up on climate that never were stood up before, that are focused on issues of climate. And you are seeing this permeate into agencies that traditionally were not taking a lead in this. Now, there were, of course, exceptions, and one of the very early kind of catalysts for regulatory action came from the CFTC, the Commodities Futures Trading Commission, which last year put together a group of both, industry side professionals, scientists, people who were coming into the topic from the industry, and began to tackle this linkage. And of course, over in Europe and the UK, and and even our Asian Pacific friends, this is all, this is not news. But in the US, this was a significant report, and it came out unanimously, and it came out comprehensively, I would say boldly. People, can disagree over the margins, over some of the things, but it was a jolt, and it was an important jolt that I would say really got the financial regulatory community focused on this linkage. And I think this is all to the good, because now with a new administration, you have a momentum. And it's a momentum that is permeating not just in the White House, but you're seeing it permeate in agencies that typically had not tackled climate. So you see it at the Treasury Department, you see it at the SEC, at the Fed, at the FDIC, OCC, even like the PCAOB, okay, the Public Company Accounting Oversight Board, which most people wouldn't imagine play a role, but of course they do play a role, because they are the oversight mechanism for the accounting and auditing profession. So there is, I would say, a sea change. The seeds are getting planted. I don't know, David, about your point about whether there's going to be a real competition. I can say, that the U.S. regulatory system does it its own way. Like they're going to tackle it their way. It probably will not be a clone of what is happening on the European side, but the Europeans have taken the lead on this, and there are extraordinarily positive templates that I am hoping and optimistic that the U.S. regulatory side will consider. So why don't I pause there and just make sure that there's, an understanding that, the U.S. is going to be there, whether or not they, end up, I'm not sure they're going to view it as a competition, but I'm glad that they are back at the table and that they are ready to be good collaborative partners in tackling these changes.
Well, thank you, Sarah. There's lots to ask you about there. Certainly under Mr. Obama, the cry was, yes, we can. And now under Joe Biden, it's, yes, we're back, isn't it? So that's very encouraging. I'll pause you there. I'm not sure whether we do have Anne with us yet, but hopefully she'll be coming along any time soon. Flora, let's go straight on to you now. You are sitting in this extraordinarily important agency, which is one of the great issuers of these sustainable bonds, green bonds. Everything you can do is these days now very much tailored to sustainability. We heard a lot from Jing Dong in the panel just now about how badly the rest of the world is doing. We from the developed world are really complaining at a very high level, it seems. You've got a lot of your clients, private sector in the developing countries, that are a lot worse off than we are in the developed world. Can you tell us, please, as one of the world's greatest issuers of these bonds, how are you combining the long-term approach towards sustainability, all the things that we care about, with the short-term approach of making sure that those countries, particularly the private sector in those countries, is just able to get through the pandemic and to get through the business of just living from day to day? How are you combining those two big issues?
Thank you, David, and thank you for having IFC on this panel. And it's great to hear from Sarah the U.S. Progress that is being made. And with IFC, as you know, being the largest private sector development financial institution, ESG really is in our DNA. We created the performance standards 20 plus years ago. We were part of the creation of the Equator Principles in 2003, which brings together, I think the latest count is over 116 financial institutions that have committed to adhering to or using these standards. We have quite a few convening, organizations where we bring members together. And so what are we trying to do as an issuer, but also as a development financial institution? I think we have really a three-pronged approach when we look at sustainable finance. And one is standardization. And standardization is something that in the market right now, you see, Sarah was talking about the EU versus the US, and of course, you see other regions, the ASEAN.
It was actually really me that was doing that. I think Sarah was trying to dodge the question somewhat, but I was doing my best. Sorry, carry on.
No worries. Yeah. Exactly. So that there are regional standards, and I guess what, the definition of standard is really that there should be one, but I think we are, if we actually dig down into the standards, there's a lot of overlap. There's a lot of similarities amongst the various standards, and IFC's role really is to help further that collaboration. The second thing we do is we look at spreading the word. We really look at trying to get all our constituents, whether it's our clients, whether it's our investors, whether it's our dealer banking counterparts, our financial institutions that we work with, we really look at working with them and really spreading the word of sustainable finance. And to that end, I mentioned the Equator Principles, but we also started the Sustainable Banking Network, which at this point has 42 member countries, totaling over $43 trillion of banking assets in emerging markets. So that network is working with financial sector regulatory agencies and banking associations. At the end of the day, climate change is a global issue, right? And so we have the developed countries working on this, but we also need to focus on the emerging market countries. And as you mentioned, those that are suffering, if you look at who's going into poverty because of climate change, and also with the pandemic, it really disproportionately affects the poor people of the world and the emerging market countries.
Just one point, if I may, Flora, before going back to Sarah. I think people have got the message, and people attending this conference and others, there seems to be so much interest in this subject. Quite often, though, there's more demand than supply, and that does seem to be one of the issues here. How do we together try to make sure that supply of genuine products, which actually do what it says on the box, meet the colossal demand that there is for these products from all over the world?
That's actually a perfect question, because earlier I mentioned there are three things we really focus on, and the third one is our support. And how do we support our clients? How do we support the market? We support through our own issuances. So we issue green bonds, social bonds. We've issued over $14 billion to date in those themes. But ultimately, we support our clients, and we try to create bankable projects for the demand that we have, that we see investors have. And so we have technical assistance programs. We provide toolkits. There's a lot of advisory services that go into and go hand in hand with the investments that we do. So, for example, and I'm sure this was brought up, well, it was most likely brought up in previous discussions, but we have two funds that we've worked with private sector companies on. One is the Amundi Planet Emerging Green One Fund, and that's focused on green bonds. It's a fund to purchase green bonds issued by financial institutions in emerging markets. And the other fund is the Regio Fund. It's the Real Economy Green Investment Opportunity Fund with HSBC, and that's focused on green bond issuances from real sector, so manufacturing, agribusiness, and health services, and the like. And so partnering with these private sector entities, really, we're looking to support our clients and try to create projects to then, these funds can then purchase these bonds. In addition, we do one-on-one client green bond purchases, gender bond purchases. We did something recently in Indonesia with OCBC, where we bought gender and green bonds from them, and the funds there will be used for projects in Indonesia.
Good. Well, that sounds really great, and clearly we need far more of this multiplication, even more than you're doing already. This takes me back to you, Sarah, this question of just joining up the pieces, because you were saying before the Americans are going to do things in their way. It's not going to be a clone of what we have in Europe. I mean, in Europe, it is obviously fairly messy, because you've got the 27 countries of the European Union. One has just left, although it's still trying to show it's still European. So things are quite bureaucratic and messy over here. Now, Paul Volcker used to describe the American regulatory system as somewhat Byzantine, and I'm sure you know what he means by that, Sarah. You've been at the center of this. Isn't it all going to be rather chaotic to get all these different people acting and hanging together? Or do you think within the 4 years we will be able to get an up and running regulatory system to look at this whole multitude of different issues? We all know from, say, the Manhattan Project in the Second World War, once the Americans start to do something, they do actually do it, and they do it properly. Am I exaggerating too much to say this is like the Manhattan Project, although clearly with a peaceful dimension?
Well, I hadn't heard it compared to the Manhattan Project, but I have to say your observation about us having a Byzantine system, we do, and it is probably not going to change anytime soon in terms of what we have. And when we refer to it as a Byzantine system, we actually don't call it that. We say it's not monolithic. We don't have a single financial regulator that is kind of the overseer and monitor of the entire financial sector. It is, there've been, over the years, there have been attempts to actually create a consolidated, monolithic federal regulator in the US. Those attempts have repeatedly failed. It really, even in times of crisis, there's been a sense of let's reorganize this, and it hasn't happened. So we have what we have, and you are right that it's going to take a particular level of coordination to keep it all, sort of keep everybody rowing in the same direction. But to say a little bit about it, when you think of our system, remember we have the Federal Reserve, which is focused primarily on financial stability. You have the SEC and the CFTC, which are considered the so-called market regulators. The SEC in particular focused on on disclosures, on market disclosures. You have the prudential regulators who sit in different agencies. So they sit some at the Fed, some at the FDIC, some at the comptroller of the currency, because of course in the US we don't have a monolithic banking system. We have a dual banking system where we have state chartered entities, state chartered banks, as well as federally chartered banks. So the system is really quite complex, and I think you're right in the sense that we do run the risk of issues falling through the cracks, right? So that you can have systemic risk develop in between the silos, and without proper attention and monitoring of those risks, you can see the development of a systemic risk. And that is, one of the lessons, obviously, that comes out of the financial crisis, this idea that, that there was not a oversight mechanism that essentially could look in between the seams of the so-called castles. I should say something else about these so-called castles, and that is that some of them are considered independent, right? And that creates another dimension that is somewhat, in some respects, unique in the United States, which is that they are really untouchable in a way that makes them subject to political influence. So, for example, the Fed is independent, and it has been structured to be independent. And so it cannot take direction, or it will resist taking direction from the White House. That's this whole separate debate, the question of independence, but it turns out that that's a very important feature of central banks. But in the realm of doing something in a coordinated way, it presents challenges. And one of the ways I think we in the US are going to work through this challenge is and this is really what I think has opened up the regulatory agencies on the financial side to climate, is that it is a risk, okay? It is not it can also be a social issue and a social good to be dealing with the need for a cleaner planet, and a planet that is not racked by the cataclysmic climate events that we are dealing with now. But the real shift, David, has come in framing this issue as a risk to financial stability, a risk to the economy. And when you put it in that frame, you really begin to crack open the dialogue that is necessary across these silos to have a meaningful way in dealing with it. And I think there's going to have to be a coordinated way in which this happens. I don't think it's a great technique to actually have each agency out there kind of doing what they want to do when they want to do it. It's actually not effective. It is confusing. So it's going to require a nice coordinating function, typically played by Treasury. That's kind of a Treasury historic role, which is to essentially sew together the different pieces that are happening on a regulatory frame. And by the way, this goes back to your original observation about the U.S. regulatory system. The Treasury actually itself doesn't hold all of the tools necessary to deal with the climate crisis, okay? The tools live in these different agencies. So it's actually not Treasury's lever to pull, but yet we have to make sure that when the Fed pulls its levers, that those levers don't conflict with the levers that the SEC might be pulling. They all need to be sewn together, I think, in a very deliberate and conscious, careful way. So
if I may, sir, just a quick question on that before going back to Flora on another point. Also, questions are starting to come in from the audience. I welcome that. I've got one or two really quite tricky questions to put to you. in a moment. Just on this issue about sewing things together, I mean, the Bank of England in Britain doesn't have universal responsibility for everything. And yet Mark Carney, 5 years ago, he did make himself fairly unpopular with lots of people, actually, by going to the front. He's not particularly diplomatic in some ways, but he does understand all the technical details. Do we need in America somebody like Carney, who he won't necessarily have all the competence in his or her hand, but it needs to be a spokesperson, not a diplomatic person like John Kerry, but somebody who actually understands all the technicalities. Is that person needed, man or woman, to do the sewing that you're talking about, but also to do the upfront publicity, the public relations, the stirring up of emotions and of minds? You know, is that what is needed, as well as all the technical competence that we've been talking about?
Right. And I think that will be the Secretary of the Treasury. I think that is Janet Yellen, who will herself understand these different levers and where they exist, and will be taking the lead in terms of how those pieces get sewn together.
Good. Well, you're just giving Janet even more work to do in her 20-hour day. So I'm sure she'll be very pleased about that, Sarah. Flora, just want to ask you now, you're headquartered in Washington, but the IFC is genuinely worldwide. How much of a difference does this new American approach make to you as an issuer, and also to you as looking to the largest financial markets in the world to buy your bonds? We've heard from people like Bob just now, the huge receptiveness that there is from America for the sustainability principles. Does Mr. Biden make any difference to that, or was this going to happen anyway?
I think it absolutely makes a difference. I mean, you know, at the end of the day, we are focused on the emerging markets, but the emerging markets and the developed markets go completely hand in hand. And as you said, we have a huge reception of investors in the US for emerging market bonds, sustainable emerging market bonds. And there's just no question that having an administration that is focused on climate for the United States will have positive effects for all our clients and all the countries we work in. So, you know, as I mentioned earlier, this really is a global, it's a global cause, it's a global issue, it's a global risk. And so having someone like the United States involved is absolutely important.
Could I ask you, Sarah, a question that's come in from the audience, a devilishly technical question. So I'm going to just read this out. It comes out of last month's statement from the SEC on disclosure. And this is, as we've heard all throughout the day today, this is a really important issue. So the SEC has pledged to, quotes, refresh guidance, end quotes, on disclosure. This was originally issued all the way back in 2010. Is any of this guidance still relevant today? The questioner asks. And then second, the questioner says, are you satisfied that the SEC statement goes far enough, because it promises to, quotes, review, assess and engage, end quotes, but there's no mention of actual enforcing. So does the SEC need more teeth? That's the question.
It's a great question, and I think it's one that Gary Gensler is going to have to wrestle with should he be confirmed. So, but the questioner raises a really interesting linkage between this notion of standardized disclosures and enforcement. And I'll tell you, the enforcement piece can only happen if there are rules, standards that exist. And I would say in the US at the moment, what we see is the development of different kinds of templates that might be good from the perspective of disclosure, but there's an abundance of them, and choices are going to have to get made regarding which are the ones that are signaling certain things, and there have to be decisions regarding what those standards are. We in the US don't have them yet. We don't know what impairment, for example, means in the climate context. We don't know what fair value means in a climate context. amortization. These are all terms that have yet to take on a climate-infused definition. And without that, I would argue, you don't have standards. And without standards, you don't have the enforcement that the questioner is asking about. So this is going to be, I think, an important decision point regarding how disclosure is going to look. Is it going to be, let 100 flowers bloom, and whatever you disclose, leave it to investors to figure out essentially what meaning they take? Or will there be a standardized approach where people where investors understand that if this term is being used, it means X. If that term is being used, it means Y. Those are two very different ways of going about disclosure. And that, I think, is going to be a pivotal question for the SEC, which is, in essence, the disclosure sort of the disclosure engine, so to speak, for investors. And I think it's going to have ramifications regarding enforcement, because I don't know really how you do any kind of enforcement if you don't have standards, because what are you actually, and what are the rules, so to speak?
And the same goes, I presume, even more for stress tests, because people are talking about scenario analyses and so on, but you can't just leave all that to people's imagination, can you? You need a certain framework. So presumably, is that part of Kevin Styra's new job, to start worrying about the stress test, Sarah, and what they will actually look like? And indeed, as you say, the link between disclosure and enforcement, is that part of his job?
So Kevin Styra's position, as I understand it, as it's evolving, and by the way, bravo to the Federal Reserve for kind of taking the reins on this particular aspect of climate. I would argue, by the way, this is just one sliver of what the federal regulatory apparatus can do and what the Fed's powers are. So Kevin, as I understand it, is looking at the supervisory aspects of climate and what that would mean from a supervision perspective. The extent to which that feeds into scenario analysis, I don't know. I don't know if that's going to be part of his mandate, but you are right that it certainly could inform it. So in other words, what is the scenario going to look like in a stress test regime? By the way, is there going to be a stress test regime? And if there is, what are the contours of it? And when does it get used? Does it get used after disclosure, with disclosure, with other kinds of tools? Those are the questions that Secretary Yellen is going to be helping coordinate. So essentially, you're right that there are other tools, but you can see how other agencies have those tools. The stress test is not a SEC tool; it's a Fed tool.
Good.
So how
we'll come back to you. We'll come back to you in a moment on that. We're going to be about another 7 or 8 minutes. I think we started slightly late, so we're going to allow ourselves to run over somewhat. I do want to come back to you on some of these big American issues. But first, Flora, something that's been most impressive at the IFC over the years, and you yourself have played a big role in this, in some of the local currency funding that you've been doing under Jingdong Hua and under John Gandolfo, the new treasurer. There's been huge aspects, huge advances made in this. Are you going to be building up the sustainable bond issuance programs, not just green bonds, but all the other things we've been talking about in local currencies as well? Because it seems to me that this is a universal issue that does need to be expanded around the world. And could you just give us a few ideas about where you're going to be doing this, what principles, who you're going to be working with? It would be very interesting to tell the audience about that, please, Flora.
Sure. So I see our role from an investor side and an issuer side, and I can start on the issuer side because that's what I do. We, as I mentioned earlier, we've issued over $14 billion in green and social bonds. And that for green bonds, we've done it in over 20 currencies. In social bonds, it's 10 currencies, I think is the latest count. So we definitely look to issue in various currencies depending on investor demand. And that really has not only the benefit of us funding in various currencies and getting the investor diversification, but by issuing in a currency that has a less developed sustainable market, finance market, we hope to then highlight and bring focus to sustainable finance in that given currency. On the investor side, I mentioned before, we are part of these larger funds. And then I also said that we do some kind of one-on-one investor roles where we'll buy a private placement of a green bond. And there, so I gave the example earlier of Indonesia where we worked with OCBC, but interestingly there, so that transaction happened last year. But in 2014, we worked with the OJK, which is the Financial Services Authority in Indonesia, to establish a framework for sustainable finance for financial institutions. So it's really that pairing of the regulatory work, some of the things that I think Sarah was talking about, but that in conjunction with actual transactions and working with the end client in getting them to issue green or social bonds.
And is that going to be a big issue? You're going to really be stepping up this work around the world, are you, to carry forward this program? So you also get some real life advances in this. It's not just words, it's actions, isn't it?
Exactly. And, I would say ramping it up, I would argue that we've already been doing this for quite some time, but it takes time. Like I said, in Indonesia, the cooperation agreement with OJK was in 2014. And 6 years later, we did this transaction. So these things can take time. But absolutely, it is a big focus for us to have that technical assistance, that advisory, along with our actual investments.
Sarah, can I just ask you now whether there's going to be some really big picture items from the United States? Because a lot of the stuff we're talking about, we all find it very absorbing. It is quite technocratic, though. It doesn't really make the front page of the New York Times, let alone the Potomac Advertiser. Are there going to be some really big questions, like, for instance, the US issuing its first green bond? Can you see things like that happening where the Americans really show the rest of the world they're going to make a difference?
That would be quite astonishing, actually. I think that the discussions regarding a Treasury green bond percolating very, very, very quietly. I have not heard, not that I hear everything, but I haven't heard that kind of reach the sort of upper echelons of the Treasury. I can say that one of the kind of bedrock principles about the U.S. Treasury markets is that they are deep and liquid, and the bonds that are issued, typically the Treasury bonds, because they represent essentially the full faith and credit of the United States. They are it. They are in essence the foundation to the U.S. financial system. What I hear is that we really don't tweak them much. I mean, that's a very high bar to kind of do much to make them more than plain vanilla. Obviously, we tinker with duration. And but in terms of kind of adding, sewing in little features, that's my sense for, what it's worth as of now. Yeah, that is a pretty high bar. That said, doing something of that nature could be a game changer if, in essence, it is done carefully, if it's done without creating collateral instabilities or sort of tremors to what I said is our foundation. So it's at this stage, at least as far as I know, a very that's kind of it's almost a break the glass kind of.
It might be a bridge too far. I've got one more question right at the very end. We're going to sew up, to use your word, we're going to sew things up in a moment. But Flora, just before we end, final question to you, please, and then I'll go back to Sarah for the final word. What things would you like to see done between America, Asia, and Europe in the next year on the whole taxonomy standard setting side? We've got a whole raft of initiatives here. Is there any one thing that you would like to see, or any one or two things you'd like to see on the standard setting side between, say, the Americans and the Europeans to basically put even more momentum behind this very considerable initiative that you have already?
Sure. So two things. One is just have that collaboration happen, right? The EU, as Sarah mentioned, is ahead. They have their 400-page plus taxonomy that goes into defining what is green. You know, that a lot of work was put in there. So it is something that I think could the US could benefit from. And this is, of course, my personal opinion. Secondly, transition finance. Transition finance is something that is controversial, but it is, again, in my opinion, something that is absolutely needed for us to get to net zero by 2030 or 2050, depending on the various metrics. You know, when you have GM and GE, you know, US companies committing to these net zero targets, transition finance has to be part of that solution. So those would be the two things.
Good. Well, I'm sure we'll meet again in a year anyway to see whether or not these things have actually been done. Final question to you, Sarah, and then I will hand over to the next session run by Danai Kyriakopoulou. Somehow Anne Simpson seems to have gone missing, and somehow we've managed not to miss her, because we've had a wonderful discussion amongst the two of you rather than three, but she may pop up a bit later on, you never know. Sarah, a colleague, friend from one of the European Central Banks said to me a short while ago, at the moment, the Americans are ringing us up every day, asking for advice, opinion, viewpoints. How do you do things on the regulatory side of green finance? And then she said to me, in a couple of years, it's going to be the other way around. We are going to be ringing them for advice. The Americans are going to be in the lead. Is that just coquettishness, do you think, by the Europeans kind of fishing for compliments because they think you're so good at these things? Or are you really going to be as good as the Europeans clearly think you may well be?
Well, I think the Americans have a lot to learn in catch-up mode from the Europeans. And again, I attribute that really to the last 4 years. And as good, policymakers do, there's no need to reinvent the wheel, especially when there's been such good work done. And so I think that is all very positive, and I don't think it needs to be viewed as a competition at all. That said, and Flora referenced the EU taxonomy and whether the US is going to take that on. The US regulatory system and the US, they do things the way Americans do them, okay? They don't really do them the way Europeans do them. And so I think what you're seeing now is a real sense of like, we've got to learn, we got to catch up with what has been done and what the first movers have started to see. And I think that's really good. So there is that catch-up mode. At the same time, I don't think that necessarily means that this is how the US is going to do it. And one thing I'm reminded, listening, Flora, to you and to all of the, terrific forward climate-focused bond issuance work that IFC is doing is keeping in mind too that the US is very market forward first, regulatory second. Okay, and the question is whether that model is going to work when it comes to climate. But you see really strong initiatives being taken in the market, letting the market kind of lead here. I would say that the financial regulatory side we need some guideposts. The market needs some guideposts here. But in the US, it's a very market first kind of approach. And the question is, can markets solve the climate crisis? So I think the US is still grappling with that really important kind of philosophic policy presupposition. So
Well, thank you so much. Thank you for explaining that. I think we've really got the message now. And I like the way you've said it's not America first, it's market first. That'll be the light motif of this session. Thank you as well, Flora, for being so engaging and also filling in the market side of what we've been talking about. We've spoken a great deal about Anne Simpson, so I somehow feel she's been here almost like the Banquo's ghost in Hamlet without actually sitting down in the chair. And of course, Anne's a great talker, so she might have actually spoken far too long and deprived the two of you from being as loquacious and eloquent as you have been. But I'm sure we will be hearing from Anne before too long, because I actually do want to bring all three of you together. That's one of my ambitions. And so I will not give up on that ambition. Thank you both very much indeed for putting all the bits and pieces together on the regulatory side and the market side. Good luck to both of you, and you're both very impressive jobs in what you're doing. And we look forward to engaging with you again before too long, just to see where we are. And we won't call it competition, we'll call it engagement between America and the United States, not of Europe, but the Union of Europe and the United States of Europe. I'm sure there'll be good engagement, and we'll see. May the better team forge ahead, and we'll see what happens in the coming years. So without more ado, I'm now going to hand over to Danai Kurakopoulou, who's going to be taking us through the next action-packed session, which is all about how America will join together even further to help to combat global warming and to cut carbon emissions. Thank you all very much for listening, and look forward to the next session, which is going to be starting after you've heard some tinkly music. Goodbye.
Hello, everyone, and welcome to the final panel of this marathon roundtable that started in Asia this morning, continued in Europe. We've had the last panel now in the US, and now we have the final panel covering the Americas and the role of the Americas in the pursuit of global net zero emissions. It's a pleasure to have excellent speakers from around the Americas and Europe today. So we have with us from Washington, the IADB and the IDB sister organizations. We have Andre Delgado, lead funding officer at the IADB, and Eusebio Garay, head of funding at IDB Invest. Also from Washington, we have the World Bank and the IMF. So the whole family in Washington is represented very well. We have Fabio Natalucci, Deputy Director of the Monetary and Capital Markets Department at the IMF, and also co-chair of the work stream for data for sustainability for the Network for Greening the Financial System that central banks and supervisors have set up. Welcome. And we have Concepcion Aisa from the World Bank, Senior Financial Officer, Capital Markets and Investments. From the Treasury side, we heard from the Treasurer of the World Bank earlier on, Jingdong Hua. We also have with us today Jörg Zeuner, who is Chief Economist of Union Investment in Frankfurt, and previously also at the KfW with a development hat on, now with an investor hat on. And we also have with us Dante Mossi, President of CABE, the Central American Bank for Economic Integration, joining us from Honduras. So welcome, everyone. I really look forward to this panel. And I want us to tackle three themes in today's discussion. So looking at the role of the Americas and how we build back better after the pandemic. I also want to discuss how do we balance the E and the S in the transition and in planning for the transition, and also how can we move the discussion around sustainability beyond just climate. We've heard a lot about climate today, but we've also heard a lot about the S. There was one panel specifically on that, and the G also being very important. So let me start with you, Jörg, on the role of the Americas. And we heard in the previous panel, David described as a wind of change blowing in the US. We also heard earlier in the day from Ayla Cravey from the European Investment Bank that Europe has a first mover advantage in the climate agenda, and it's at the forefront of this development, but that doesn't mean it has to do the same thing, and that the US can also develop in its own way. And Sarah Bloom Ruskin very much pointed out this message as well in her remarks just now. So in your view, Jörg, what will be the impact of the change direction that we're seeing in the US? We heard a lot about the new developments, the new roles that regulatory institutions are taking. How do you think this will affect? The US has rejoined the Paris Agreement, has joined the NGFS. How do you think this will impact the sustainability agenda?
Yeah, thank you, Dani, and thank you very much that as the last European speaker on today's conference, I have the first mover advantage, and that's where I'm going to start. It's the European Union has a bit, and this was mentioned on the panel earlier by Sarah and by you, has a first mover advantage a little bit over everybody else, and in particular over the US in a number of areas. When you just look at, just to mention two, there are various numbers out there, but let's say 8 out of 10 clean tech companies are registered and operating in the European Union as of today. And around 80% of ESG mutual funds, fund assets are being held by European asset managers. This number in the United States is a lot smaller, somewhere in the single digits, according to the numbers that we are using. When you think about climate policy, the US just rejoined Paris. We have some pretty advanced green regulations here in Europe, but it is true that the United States will catch up, and it will catch up fast unless domestic politics intrudes again in 2 or 3 or 4 years. Of course, the goals are similar because they have been set on a global scale. So Europe, Asia, the Americas are all working towards the same goal, net zero by 2050. The share of, for example, the renewables in electricity generation that different parts of the world want to reach are more ambitious in Europe. That's no surprise, as the renewable sector is I would say, most competitive of the European sectors in terms of achieving the non-zero emissions. So it's a little bit more front-loaded here than it will be in the US. And it's going to be interesting, by the way, what China is going to do as a response to all of this. But when you look at estimates on how many gigawatts of capacity in wind and solar are going to be to go online in the United States, the universe of investments is enormous. Compared to Europe, we have about $1 trillion now in the European Green Deal. When you add up the American numbers, realistically, we're already talking about around $2 trillion. Possibly, so the packages are larger, the economy is large, but the packages are larger. So there is definitely going to be a lot of catch-up. And one of the areas that I think we should focus on a lot is not only the numbers, but also, as was mentioned before, is the regulation. What is the US going to do in terms of regulations? I expect that the US capital markets will grow very fast. They're already growing rapidly, and this will continue in the sustainable finance area. And it's going to be very interesting to see what the SEC is going to do, what the disclosure requirements are going to be for US corporates, what the sustainability targets for US pension schemes will be. All of this will determine quite many things. We're not yet there. It's early days. Not everything has already been announced, but I expect that a lot will happen. And given the depth and the size of the US capital markets, there's going to be a lot of things happening. And my last point, this is not going to be all nice and fine for everybody. I expect along the way quite some contentious issues because there are other policies that intrude or conflict with climate policies. When you think, for example, of America First, when you think of I can't see a Chinese climate policy that is entirely open to investments into the Chinese economy where there's not some sort of benefit or protection. The same is true for the US, maybe less so for Europe. The whole issue of the carbon border tax, for example, that Europe has tried and failed, and now the US may be pushing for the same thing. So this is going to be quite an exciting period because it's not only going to be a catch-up, but from my point of view, we have some conflicts ahead. Another area to think of is, for example, the batteries world, the supply chains in the solar industry, the inputs into solar panel production, that are critical, all those things. So I expect a catch up, and I expect it to be quite exciting because I don't think it's without roadblocks on the way, and it will bring up a few very interesting issues, and maybe some are coming sooner rather than later. Again, the carbon border tax is a good example. where it's going to be interesting to see. Also for the rest of the world, because these are measures where maybe the US and Europe would be on the same page, but everybody like Brazil would not be. So interesting times ahead with a US administration that's moving back into the ring, if you want.
Thank you, Jörg. Yes, great points. It's a bumpy road ahead, so a catch-up, but at the same time, conflicts that may arise, and it won't be a smooth road. And I imagine also as the pandemic recedes and this coming together of different regions to confront a global challenge may take a step back, we will see some of these distinctions and divergences become even more acute. So thank you for raising that point, and we will come back to that as we talk about the conflicts also between the environmental goals and other goals that that come under ESG, but also outside of ESG, as you mentioned, protectionism and other policies, policy priorities. Let me turn to you now, Andre, and we heard from Jörg just now about Brazil. We heard about supply chains and batteries. We've heard also earlier from Jingdong Hua, the Vice President and Treasurer of the World Bank, that Latin America has been one of the regions hardest hit in this pandemic. I think Jingdong said 6 of the 10 hardest hit countries are in Latin America. He referenced some of the innovations that we're seeing there and elsewhere, also in other regions in terms of capital markets innovation, disaster risk financing, catastrophic bonds, and so on. Could you tell us a little bit, how do you see the region recovering from the pandemic in a sustainable way? And what have been the IADB's projects in achieving that and its role in the pandemic?
Okay, sure. Thanks, Lenny. And good morning from Washington, D.C. area. Indeed, as you said, the Latin America and the Caribbean has been disproportionately, perhaps, severely affected by the COVID pandemic crisis. And it will, of course, have consequences for the progress of climate change, and as countries are now mostly focused on the recovery. So climate change and sustainability concerns remain, though, critical for Latin American and Caribbean region, and the countries do understand that their development is cannot be really achieved without a sustainability component. Recent reports from the IMF, they are saying that the region as a whole is expected to contract about 8.1% in 2020, which is above the world average of 4.4%. So it is highly affected, the region, and with also in terms of the human cost, with about 80% of the population, it has reported about 30% of the COVID-19 death. So has occurred there. So it is again disproportionately affected. And most shocking is the impact in the health systems and the economies. And some groups, notably poor people, and will be disproportionately impacted as well, with long-term consequences that are hard to predict. Again, the progress we have made in other fields, like, for instance, gender equality, will also be backtracked, as well as other groups will be affected, will be indigenous people, African descendants, people, persons with disabilities, etc. There was a temporarily dip in greenhouse gas emissions because of the reduction in the activity, but that's not really expected to be significant in terms of combating climate change. And with all that background, what did IADB do? So we basically mounted historical efforts to support the countries in their efforts to confront the pandemic. And as a group, IADB approved a record 21.6 billion in lending in Latin America, which is the world's hardest hit region. For instance, just to give an example, this was an 11% increase only in the sovereign guarantee approvals as compared to 2019. The response was really unprecedented, and the focus of the IADB was in immediate public health needs, safety nets for vulnerable populations, as I mentioned, and economic productivity and employment. The region was also very affected by the loss of jobs and the destruction of jobs. So HB was there to support that part. This growth will continue in 2021. We expect that again, the bank approvals and disbursement in 2021 to exceed records. And I work on the funding side. On the funding side, we also had a record borrowing program of 26 billion. We did 26.8 in 2020. We increased originally it was a 20 billion. So due to the pandemic, we increased the borrowing program. And also it was interesting to note that there was an increase in interest for the part of investors for sustainable development bonds in 2020. Most of our bonds end up, of course, focus on SDG number 3, good health, but we also did other bonds with the climate change angle as well. So, and on the back of that, we had a record issuance of sustainable development banks, of sustainable development bonds in 2020, with 8.2 billion issued in 8 different currencies. So to resume, this is like a critical time for the Latin American, the Caribbean, and the banks. The IDB group leadership is working very hard to continue in the way of development, in the way of sustainability. Thank you.
Thank you, Andre. Yes, definitely a very active year for capital markets and issuance. We've heard that also throughout the day. Also interesting the point you made about issuing in many currencies. And I'd like to come back to that at some point in the panel, maybe to you and Jörg as well, about the role of the euro versus the dollar in dominating sustainable capital markets in the Americas as well. We've seen a lot of sustainable finance issuance be in euros, but as we are discussing the new role for the US and the Americas in this, it may also be another bump down the road to use Jörg's thinking there of what differences and changes we may see. But let me turn now to President Mossi, president of CABE, another institution that's been very active in capital markets this year, and we've worked very closely together with Omfif CABE. We published a report earlier this year which looked at integration efforts in Central America, and indeed one of the pillars that we covered in the report was the sustainability side and how capital markets can promote sustainable development. So could you tell us a little bit about CABE's activities in capital markets this year? Because we've been talking a lot about Corona bonds in Europe, and there was a lot of debate about Corona bonds, but actually CABE issued one for vaccine, to finance vaccinations in Central America. So could you tell us a little bit about your activities there?
No, thank you very much. You know, the advantage of CABE is that, as you know, we have membership both in both sides of the Central America area, so both in Europe and in Asia. So that gives us a huge advantage of having a very diversified access to capital markets. And I gotta tell you that last year, actually, we provided the first Corona bond, and it was very successful in Asia, in Japan, and also in New Zealand. And we got really low yields from that debt issued to finance the vaccine effort in Central America. We have committed $800 million for the vaccines, and that actually came out very cheaply. I mean, almost at AAA levels. And but also, you know, more importantly, we also sold an ESG bond, global market, and thinking of the, you know, the social impact that the coronavirus had in the region. And the response from the global markets was fantastic. I mean, again, very diversified, Europe, the US, and Asia. So I think it's very important for this region in particular that has been so much affected by, you know, two crises, the coronavirus crisis and the climate change crisis at the same time, the same year. And so CABE has been very well placed to actually to issue debt in those markets, and we have been able to react very quickly to our member countries. So we're very proud that we came first with the funding. So it's an issue of opportunity. So we had also, you know, 2 hurricanes hitting Central America 2 weeks apart. So this is totally uncommon. I mean, whoever doesn't believe in climate change should come to Central America. we produce less of, very little, greenhouses gases, and yet we suffer very heavily on the impact. So the destruction in housing, in roads, and in the whole social infrastructure, water systems was so bad. And so the ability to go to the markets and tell the markets, this is what we are doing to get this region back on track. And the capital markets reacted very transparently and provided funding just when needed. So I'm very happy that markets are with that sight on the short term, but also in the medium term. CAVE doesn't leave the commitment with the region to have this industrial revolution. So we will still be working in railroads, in gas, in development of more investment and trade, better ports, better airports, better overall infrastructure. So in that sense, capital markets have been actually very committed to us, and the reaction has been fantastic in terms of providing very low rates, which we can actually pass on to investors or governments. Because one thing we have noticed is that in the region, Central America, governments have detected how public debt have been increasing, so they are looking towards more PPP transactions. So that's why we actually look forward to the UK a lot to get some good practice from that. And so this capital that we are raising is actually helping both the governments but also the private sector. So we are very delighted to be where we are at this current time to help these countries to get back on their feet. Thank you.
Thank you very much, President Mossi, and thank you also for reminding us that climate change means that while we're all in the same storm, we're not all in the same boat, and some countries are suffering more than others. Some income groups are suffering more than others, but the question is how we can turn those particularly heightened risks that some countries are facing into opportunities, and what capital market solutions can we find, such as disaster risk financing. You mentioned the hurricanes, for example, and the latest issue of the Sustainable Policy Institute Journal looks at exactly that. We've had a lot of innovation on that in Asia that other regions can learn from, so I encourage you all to read that. Let me turn to you now, Fabio, and the IMF. We've heard throughout the day about different approaches in Asia, in Europe, in the US. Jörg has also highlighted the potential difficulties that we may encounter as we move ahead. And in coordinating a lot of this action in your role at the NGFS and at the IMF, how do you think we can move forward in terms of establishing common metrics, standards? To what extent do we want to have convergence? Does one rule fit everyone? Or how do we have rules that acknowledge local context, but at the same time avoid the risk of fragmentation? And what is the goal of institutions like the IMF in supporting this?
Thank you, Dan. Thank you, first of all, for inviting me. It's a pleasure to be here. So I think there's clearly positive momentum for better quality data and disclosure, right? That comes from a variety of stakeholders. People are asking for consistent, granular, comprehensive information. There's a number of efforts, as you mentioned, for example, to develop disclosure frameworks. But these various multiple frameworks have also led to a quite fragmented landscape. There are different standards out there, even for similar topics. So there's clearly a need for consolidation, because if you don't have recognized uniform framework, that makes implementation, consistency, and comparability much more difficult. Right? So we need, in some sense, clarity of scope. We need a coordination among the various efforts that have been implemented, and also convergence on some key conceptual issues. I think the way we think of this is kind of like a building block, right? So it starts with the data, it goes through taxonomy, which is essentially some sort of common language. You need a framework to think about this. Again, a framework, then it's a bookshelf. You need some books inside a bookshelf, so you need to discuss data. Then there are implementation issues. Some of them you mentioned, mandatory versus voluntary, a number of other issues related to implementation. And then there is also the disclosure part, and that takes you to disclosure not only of, for example, climate-related data, but also how do you do the link between disclosure of climate data to disclosure of financial variables. So ultimately, that's what investor cares for. So the way we think about data is the starting point, right? So we need robust, high-quality data on, and picking climate as an example, on exposure and vulnerabilities. And so, but you also need to clarify, and that's what we're trying to do with the NGFS, with the bridging the data gap, clarify, think about data and making user-centric approach to data. So what data demanded by whom and for what purposes? The different purposes one can think, right? There's financial stability, risk assessment, there is financial institution stress testing, there is the objective of fostering sustainable finance markets, and there's also other objective like financial institutional risk management. So you need to start from data. Now, despite all this effort, there are still significant data gaps out there, right? So one can think of the TCFD report where they clearly show that companies are hesitant to disclose granular information, and also still work to do in terms of not just the metric, but the targets as well. Then we need also common language. So we need to think at some point how to get to some minimally agreed global taxonomy, so that we don't have the European Union taxonomy, the Chinese taxonomy, maybe the US taxonomy down the road, or someone else's taxonomy. We need to have some minimum common language that we can communicate. Then the next step is the framework. I mentioned that TCFD is probably the one at this point that's the best foundation. Again, sticking with climate, it's climate focus, it's principle-based, has extensive support under the FSB, and it's generally broadly agreed set of principles within this kind of conceptual framework. There are then the implementation issue. So issues are like adoption, again, voluntary versus mandatory, materiality, whether it's a single, double, dynamic, scope, whether it's just climate, environment, the entire gamut of ESG, and all the other modalities. And then finally, the issue of disclosure. And now you go from disclosure of ESG or climate data to financial disclosure. How do you link it to financial variable, which is what investors ultimately are looking at if you want to think of assessing climate risk. So in some sense, to me, we need to think about these building blocks and think about all the pieces together. So we have a flow to where we are, and ultimately the objective will be some sort of minimum standard globally and some sort of minimum standard in terms of disclosure. The issue is how you get there. How do you get there so that it's the end point, but also being cognizant at the same time of different sensibilities across jurisdiction, or different path to get there, and different timing as well. I think that is the big challenge. I think the challenge are two. One is convergence, and how do you bring everyone on board so that at some point down the road, you get to some sort of minimally agreed, common, mandatory, hopefully, preferably, standard and disclosure.
Thank you, Fabio. And I think your message about bringing everyone along is very important, because there is a trade-off between setting very strict standards and making sure that SMEs, that developing countries that don't necessarily have the resources, can comply with those to have a level playing field if these become mandatory regulations. So thanks for raising that. I'd now like to move to the second theme for the panel about how do we manage potential conflicts between the E and the S, the environment and the social, in managing the transition. And let me turn to you, Concepcion, from the World Bank Treasury. When we think about the developmental objectives of, for example, supplying energy in a developing country, a lot of the emissions are coming either through supply chains or directly from the advanced world, who have had their go at industrialization, and now we're telling emerging markets, well, you can't have that. You have to manage your emissions. You have to manage the environmental risks. How do we balance these two? If investors are faced with the conflict of providing or building a project that will provide energy to a developing community versus complying with environmental regulations, how do you see the way forward?
So, well, first of all, thank you very much, Danae, for having me here and for inviting the World Bank Treasury to this event. So on your question regarding climate risk, development objectives, and energy, we don't necessarily see this as contradictory. On the contrary, we think that there is a way that you can align them, and where you can find synergies and one can help the other. And we can give you examples of the climate insurance industry where we have, for example, in the past, helped countries in the region, as for example, it happened in Uruguay, where we did a weather derivative. And this weather derivative, actually, it was linked to the energy transition of the country. At that point, when Uruguay approached us, the hydropower was 80% of the energy of the country. So when there was a drought, the country was totally subject to the volatility of oil prices, right? So, and they wanted to diversify that energy matrix towards a more sustainable one, right? They wanted to do investments in other kind of energy. So what we did is we created with the market, with the insurance companies, we helped them to build a weather derivative, which is like a kind of insurance, a hedge that has different triggers linked to the lack of rain, the drought, and then also linked to the price of oil. So while having this hedge, the country was able to go more into sustainable energy. So going back to your question on the capital markets, investors have the option to go into this. And I think we should go more towards this kind of investments in a way as a way to back up the industry and all the sustainable finance acts that are. I don't think that more and more than countries are looking into whether investing in a country in an energy project or looking more into sustainability. I think both projects can be aligned, or you can even find ways in which even if the energy is having a project is having a lot of CO2 emissions, there will be a way to net them out. So all this to tell you that climate risk is a reality, is something we need to take into account into these projects. And in order to achieve the development goals and to deal with the energy transitions, you need to take into account this climate risk, and you need to be to make whatever sustainable investments you do really sustainable over time and in terms of the environment, because otherwise you are just having a very short-term solution.
Thank you, Constantine. A more optimistic way to resolve this dilemma, or perhaps say that it's not there at all and that we can have sustainable projects. But I think framing it with a long term in mind is the way to resolve that. Let me turn to you now, Eusebio, from the IDB Invest. And we heard earlier from Fabio that having the taxonomies is about having the bookshelves, but you also put the books in. So how is the private sector in the regions that you cover approaching managing climate risks, having data, reporting them, and also what has been your experience in working with the private sector in managing the potential conflicts between the E and the S and the impact investment projects that the IDB Invest has had in the region?
Thank you very much, Dana, for inviting me to this very, very exciting panel. I represent IDB Invest, the private sector institution of the IDB Group. We are a multilateral development bank focused on financing sustainable enterprises in the region to promote the economic, social, and environmental development. And to your question, how do we see this environmental and social tension? In our view at IDB Invest, environmental and social are not alternatives. They are complementary dimensions of every economic activity. Every economic activity has an environmental impact and it has a social impact. That impact can be positive, can be negative. And that's how we approach our projects. Our impact management framework looks at opportunities. What are the opportunities in every project to promote the environment, to promote positive social impact, job creation, increased equity, etc. And on another tool we have, our risk management, ESG risk management framework, looks at the risks. What are the environmental risks of a project? What are the social risks of a project, the positive social externalities? And we balance both. We look at those dimensions. Looking specifically at climate, first of all, and to finalize, and that's why when we look at a project and we look at the impact, we always map every project to the Sustainable Development Goals. And it always results in mapping one project to a number of the SDGs, which always include, I think without exception, or with few exceptions, environmental and social impact. So some numbers, the Paris Agreement means that Latin America and the Caribbean needs to invest in a conservative estimate around $80 billion annually to implement the goals, the NDCs. And infrastructure needs in the region are around $180 billion. So this is humongous task for Latin America, and it cannot be done without the private sector. We at IDB Invest are best positioned to support, and we have essentially 3 pillars in our climate strategy. First, we focus what we call investing in reversing, supporting the transition to sustainable financial sector, encouraging our financial sector clients to lend to sustainable projects and helping them develop the tools to do so. And then with the real economy, we look at focusing on low carbon and resilient investment, mobilizing resources and supporting our clients to tap into the capital markets. We have a explicit goal of a minimum of 30% climate finance projects in every year, and we seek to have at least 40% of our portfolios in at any time with a climate investment component. The second pillar is about managing climate risk, physical and transitional. And specifically, we developed a tool and processes to help our clients identify and manage the climate risks in their own portfolio. Really a very systematic tool which helps them identify risks and opportunities related to climate. And the third pillar is walking the talk. We mainstream climate within our institution, becoming a climate smart institution. We have been TCFD supporters, and Fabio mentioned already the importance of TCFD since 2019. And also we use our funding program to let investors participate in our impact. We issued last year 2 COVID response bonds, actually 3 COVID response bonds, $2 benchmarks, 1 Australian dollar issue, and the benchmark saw our largest book ever, a global investor participation across the Americas, EMEA, and APAC, and including specifically Japan. And also this year we launched our sustainable debt framework, a framework which allows us to issue green bonds, social bonds, sustainability bonds, reflecting this multi-dimensionality of the projects. And we will soon be launching our sustainable commercial paper program, giving money market investors an instrument to support development. Summarizing, we think that these 2 environmental and social are complementary dimensions of every project, which have both risks and opportunities, and we help our clients see both, manage both, and therefore help them transition to a more efficient and economically attractive, but also to a more resilient and long-term sustainable economy.
Great, thank you, Eusebio, and great to hear from you all. We'll move to a final quick round to hear from you again. And as we have about 10 minutes left, 15 minutes left for the panel, but building on this idea of risks and opportunities, but also you mentioned job creation, I'd like to ask you, President Mossi, because clearly job creation is something that is of a high priority agenda in all countries, but especially in Central America, as it interacts with the migration policy. How do you see the opportunity through sustainability of job creation? Because we've been talking a lot about stranded assets throughout today, but it's also the question of stranded jobs, a lot of industries that transition. How can we ensure that this is balanced to creation in the sustainable industries of jobs?
Yeah, I mean, that's a complicated question, but let me tell you how we are thinking through this at CAVE. I mean, two ways. One, working with partners, with public investments, like in certain sectors like housing or major infrastructure that is very labor intensive. We're financing air dams that, to contain rivers during floods and also to provide water during the dry season. But also it's a way to generate employment, in this region that have been affected by climate change. So, and we are looking at, from the public investment side, but from the private side, and before moving on, and also we are looking for partners for that process. So we have been really blessed by having even new partners coming to Central America that are very interested in job creation and preventing illegal immigration like the US. So DFC has provided a loan directly to CAVE for the first time ever in the history of CAVE, because they see, we are actually providing physical results that generate jobs. But to the second angle is how to help the private sector. So basically what we have been looking at is how to give a second chance to companies that already have loans and have gone into trouble because of COVID. So basically what we did is that, beyond the traditional lending with longer grace periods and lower interest rates, is also to use other financial tools like guarantee funds. And again, I need to thank the European Union and Germany in particular to help, in funding these guarantee funds to assist companies that already have loans on their books and they're afraid of taking additional loans. And lastly, but not less importantly, is the use of capital markets in the most essential way. I mean, CAVE has presence in every country of Central America. So what we are doing is also we are using our investment portfolio to sell bonds locally. So we can provide loans in local currency to small and medium enterprises. That actually has become very useful. I mean, there are barriers towards using local markets, capital markets, which are very limited. But if you want to develop the capital market, you have to work with them. So CAVE is actually trying to work, not only at the global scene with ESG bonds or vaccine bonds, but also with local capital markets and create a Central American debt market so we can actually assist the private sector to start giving the first steps towards using capital markets in a more efficient manner. So we're very busy.
Thank you, President Mossi.
Thank you.
Yes, very important point to have the local capital markets development, and Jingdong Hua made that point earlier on as well. Let me turn to you now, Jörg, because we've been talking a lot about transition, and the concept of transition finance has been mentioned a lot. We've started with green bond finance and blue bonds and all sorts of colors, but now the focus is also on helping industry sectors, companies transition. And how do you see that changing the investor approach to ESG investment? Because in the very beginning or at the start of someone's investment journey, divestments are quite a popular strategy. It's easy to do. It gets you a lot of headlines that you're divesting from an entire sector. But how can we have capital markets and finance actually supporting the transition?
Maybe very quickly on Latin America as a investment area for ESG investors. For us, it's quite difficult to invest there. It's the area where there is lots of opportunities in many sectors: water, hydrogen, rainforest, wind, solar. At the same time, many countries lack a climate strategy, and a lot of companies lack data that can be used to assess where they are in this transition process. It's just sort of a general remark, if I may, on Latin America. But it leads me to the point of transition, because this is where we need this data. Because for me, the transition financing is going to be the way to go in ESG investing in the future. For a number of very simple reasons. Simply, when you think about your portfolio, I mean, we all know the pioneers in ESG investing, but they're expensive. But what we need to know is who are the pioneers of the future, so to speak. Who are the leaders of tomorrow? Who is transitioning into this new, more sustainable economic system? And these should be our targets, because this is where you can have the returns on your investment. Those are the transitioners. So simply focusing on divestment only or on the stars in the ESG world is not going to be enough. Also because our clients are changing, the demands are changing, the investment needs are changing, and all of this can only be achieved if we focus on the transitioners. To making the green companies greener is not the way to go. It's making the brown companies green. And I think also from a public policy perspective, it's the way to go. So for me, this is definitely the area where ESG investing will move to and evolve into over the next couple of years.
Great, thank you, Jörg. And absolutely, I think there's also the whole debate around the concepts of additionality. We don't want to be increasing the electricity and energy generation capacity. We want to be greening it. But turning to you now, Concepcion, and thinking about the World Bank as an issuer. You've issued a lot of sustainable bonds. Where do you see the demand coming in, and what kind of colors are becoming the most popular? Where do you see the market moving? Is it green bonds, blue bonds, SDG bonds? We've heard a lot of options today.
So we see obviously the green bonds are here to stay, no? But I think reality is making us moving more into what even we call SDG bonds and SDG awareness bonds, because they just don't deal with green. No, also many things that were, or many times things that were already included in the green, now they are like being splitted, no? What we see also is a movement towards social and towards health, all points of sustainability. So I think we are going to move to see a demand of the market moving more towards all of this. In Latin America, Ecuador, actually with the guarantee of the Inter-American Development Bank, issued a social bond last May for social housing, right? So, I mean, governments are going to start doing this. And also, the other area that my Vice President and Treasurer Jindong has mentioned, catastrophe risk financing, right? That has to do with climate change. That's also something where Latin America can play a very important role, because most of the market in that area, the investors need diversification, and most of the portfolios are invested in the U.S. market, and Latin America, as we saw with the Pacific Bond Alliance that was issued in 2019, offers that opportunity to investors to diversify risk that has to do with catastrophe risk financing. So for sure, sustainable financing is here to stay. Probably, I mean, we are seeing an evolution of this market that hopefully, as Fabio was mentioning before from the IMF, it will go through a standardization, because that will help to guide investors. And of course, SDG is here to stay, and it will move more to other concepts beyond what is purely green. That's what we see happening right now.
Great, thank you, Concepcion. And coming to you, Andre, now. In your operations throughout Latin America, how do you measure your impact in the climate area, and how are you starting to measure your impact also in other areas? We've heard about the environmental risks as well, going beyond green and the focus on climate. What are your operations on that?
Okay, sure. Thanks, Dana. Basically, we do choose for each of the Sustainable Development Goals, one or two or a couple of metrics that would be relevant, and something that would be able to measure for each one of our projects, and we then report those into our website. So specifically for the climate action SDG number 13, the key number is 14 million annual tons of CO2 equivalent emissions avoided by the IDB group projects. And we do have a corporate results website where we can actually select the projects and see which countries and which institutions of the IDB have been active on those, and which projects are contributing to those goals. So each one of these goals will have a different type of metric. Life below water would be the number of hectares, terrestrial and marine areas with improved management, for instance. And again, it's also possible to see which projects and filter by country, etc. Just to clarify, the 14, to be more precise, 14.4 million tons I mentioned just before is for during the period of 2016 to 2019. And we also have approved for 2020 a new framework, and that will change a bit the standards to measure to apply measurements, and which projects will be applying the measurements. And this new framework basically sets ambitious new standards and that will help IDB clients to tackle environmental and social issues, for instance. Let's see.
Thank you, Andre, and for mentioning also metrics and standards, because we have seen a lot of progress in metrics and standards on the green side. We mentioned throughout this panel about the taxonomy, about the TCFD efforts. How can we are already saying that there's not been enough progress on this, and we're still struggling to establish it. How can we catch up in other areas? Fabio, what is your view in terms of the initiatives that you're seeing? We've seen that TNFD, for example, created a task force for nature-related financial disclosures. We've seen some central banks start to think about biodiversity risks. Do you think that that is going in the right direction?
So I think in some sense it's all start with data. So the reason why at the NGFS, the Bridging the Data Gap, we start with climate, it was for practical purposes. So there was so much work that needed to be done thinking about data needs, the data availability, gaps, and disclosure, that we thought it was natural to start and do a deep dive into a subset of the, in some sense, right, climate. And I think that effort may in fact inform how to think about the broader ESG issue. So if I need to pick like a couple of examples, if you take the various ESG rating across different scorers, you get, depending on which one you're looking at, the correlation can be high or low. And so you can get a very different answer in terms of scoring for the same firm across different ratings. And that clearly creates some challenges for investors if you want to price risk and opportunities as they relate to ESG. That includes both in terms of the data that have been used, the methodology that have been used, what essentially categories goes in. So if you want to move the broader ESG toward the same path that I was discussing before for climate, I think you need to start with the data. You need to make sure that you have robust quality data, that they are standard, that you can actually compare if you get ratings from different scorers. That's the only way to allow both investors to price ESG risk and opportunities, as well as risk management, to actually be able to assess risk as they relate to ESG. As well as for the regulators who start thinking about this issue. So if you want to move in that direction, we need to start working on the data side first.
Great, thank you, Fabio. And I think one question when we think about data is, what data do we need companies to disclose? Is it just how ESG factors are affecting them, or is it also how they are affecting the environment, social conditions, and governance? And that's the question about the double materiality or single materiality. And the focus so far in the debate has been very much on the risk lens, but we are now starting to see also how can we see opportunities also in managing companies' operations with regards to ESG factors. So let me turn to you, Eusebio. How do you think about this issue about double materiality, and how do you see the private sector in the regions that you're operating in take advantage of the opportunities? What are some perhaps success cases that you've seen in your work?
Thank you, Dana. Frameworks like the TCFD or the much anticipated TNFD, the Task Force on Nature-Related Financial Disclosures, recognize exactly that double materiality. And the TCFD is actually a good example of an approach that is still voluntary, but has already taken hold in the private sector. And of course, we see right now rather the larger companies in the region with a global shareholdership and a global client base kind of being at the front of these developments. Overall, the private sector has been learning and advancing a lot recently. I think, though, that consolidation in terms of the myriads of ESG-related standards and frameworks is absolutely key and will be immensely helpful in that space. And we start seeing first steps in that direction, like the World Economic Forum stakeholder capitalism metrics. Risk and opportunities are two sides of the same coin, right? So as we talked before, sustainability or the carbon transition presents risks, but they also present huge opportunities. And an example is, for instance, the fact that solar energy has by now become the cheapest electricity source. You asked about examples, and I wanted to mention one recent project we closed recently in Chile with ENGIE Energía, with the aim of accelerating the decarbonization of the country's electricity matrix. We essentially, this is the idea is to build a wind farm with a capacity of around 151 megawatts as part of ENGIE's energy transformation plans, which includes closing the successive closure of their coal-fired units and the building of more than 1,000 megawatts of wind and solar initiatives in Chile over the next few years. This, where we are innovating is structuring a pilot financial instrument as part of this package to accelerate the decarbonization activities in Chile by monetizing the displacement of greenhouse gas emissions when closing the thermoelectric coal plants early and replacing them with clean technology projects. So one of the tranche of the 125 million has been established such that essentially there is a minimum price for the offsets, the greenhouse emission, and it lowers the financing cost of that tranche. To calculate the cost of the displaced emissions, we developed a methodology tailored to the project and expect that this will serve as a model which will be replicable in other projects, not only in Chile, but across Latin America and the Caribbean. Another example, very briefly, which is a project we have been working for 2 years now in the Caribbean with water supply companies to create a mutual insurance scheme where they insure each other against climate risks, especially hurricanes, in an area where the classical insurance market isn't working, it's not active there, and the premiums of that insurance scheme will be linked to the implementation of resilience measures. So these are two examples of successful implementation of climate change mitigation and adaptation and incentivizing private sector institutions to move along. And that will eventually also drive their disclosures and the transparency moving forward.
Great, thank you very much. And thank you to all of our panelists. We could have gone on for much longer, but I'll slowly wrap up to hand over to Frank Scheidich and Anne Simpson, who has joined us in the end from CalPERS to close the conference. But first, let me wrap up. Thank you, all of you, for your excellent remarks. I think some very important takeaways. We heard from Jörg that we see the US now coming onto the stage. It will be a bumpy road. We've also heard that Latin America is a region that has been hurt more than others in the pandemic and also in the climate crisis with a lot of natural disasters. We're not all in the same boat in this climate storm, but also an optimistic messages in terms of the opportunities that there are. We heard just now success cases from Eusebio. We heard from Concepcion earlier about the conflict between the E and the S not being as much of a conflict if you have the right framework. But also at the end of the day, it's all about data, making the right decisions, having the frameworks, the taxonomies, and thank you to Fabio for raising these points as well. So thank you very much to all of you. It's been great to have this discussion, and I hope we will continue them and that by the next time we will have made a lot more progress. Over to you, Frank, to close this marathon conference.
Thank you very much, Denai. You were ahead of time, actually. I'm not even sure whether David and Anne are in already. I can't see them for the time being. But thank you very much. I think that was a great, impressive panel, what you have done and moderated there. Thanks to all of you for participating. If you see my background in the window here, the sun has sunken and we can't follow the sun anymore, but you definitely do over in the US, and that is also my pleasure to say that we will end up everything over the next half an hour. And with Anne Simpson, based in California, Sacramento, the sun has just risen. And we missed her due to technical problems beforehand. And I'm so glad that she was flexible enough to make it happen, that and also David, that he is as flexible, that both of them could continue more or less the panel before yours, and we can listen to them. And I will wrap up and round up the day and the 10 hours what we have had today. I have to thank you all. Thanks very much for contributing. I'm back in 20 minutes from now, and I hand over to Anne Simpson and David Marsh. Thanks for joining us.
Thanks very much, Frank. Yes, this is like a coda at the end of an opera, basically. And you're coming up again by popular request. And it's a perfect way of ending the day, because we started off in the morning at breakfast time in China and Singapore, and we're ending up early in the morning in San Francisco. So you couldn't ask for a better way of doing it. World geopolitics and also capital markets because of the Biden administration. Now, you've been somebody at CalPERS for quite a number of years now in your new job as Managing Investment Director, Board Governance and Sustainability. You very much believe in joined up effort around the world. You're already lined up with a lot of other very large asset owners. You're lined up with a lot of companies You believe in shareholder activism. You have done this now for many, many years. What difference does the Biden administration make to all this?
Well, first of all, thank you very much for letting me join you, giving me a second chance. So second chances in life are always much appreciated. And congratulations to OMFIF for doing a Jules Verne. You've been around the world, not in 80 days, but just over 8 hours, which is extraordinary. So I'm just delighted to join you. The question about the Biden administration is a very good one, because what it highlights is that the financial markets rely on the public sector to set the rules of the game, to make sure that markets have the information that they need. Right now on climate change, we have precious little, but not just on climate change, also issues like human capital management. We can talk more about that. But so agenda number one is, if we want markets to work efficiently, they need the information to allocate and to price, and also to inform investors in their stewardship. Secondly, we need the public sector to address the incentives. And pricing relies on those incentives being properly addressed, and that puts the focus on carbon pricing, because here we are with this existential threat, and that matters for investors, not only for society. We cannot invest and generate returns in an economy which is collapsing under the stress of climate change. So climate change is a financial risk. For that reason, we need not only fossil fuel subsidies to be removed, because that's giving a false prop to carbon, which is in conflict with the goals of the Paris Agreement, but we also need to price carbon, because carbon gets a free ride. And that means on every element in terms of the transition to a low carbon economy, the costs of carbon are being borne outside companies. They're being borne ultimately by the taxpayer. And so an efficient market requires both the information, but it also requires us to price externalities properly. On the back of that, the financial markets really can be a powerful driver of change, both in self-interest, money talks on this, as with everything. We need these investment returns to pay pensions. Every investor has a financial objective, but we can't get there over the long term unless we address the systemic risk of climate change.
But in terms of the new administration, I remember during the campaign, Mr. Biden had to be a bit careful about this, because after all, you do have a very large fossil fuel industry in the United States. You are now moving into this position of energy independence. There's going to be a lot of jobs put at risk in America, in the heartlands of America, if you go too quickly towards carbon pricing regime. I think he did modify his tone somewhat on these issues during the election campaign. How can Mr. Biden, as president now, square his ambitions to be very collaborative and very multilateral with the rest of the world on climate change, with his own domestic responsibilities to preserving jobs in some of the heartlands of the American industrial system?
Well, let's take the issue of jobs first. There are now more people employed in the renewable sector than oil, gas, and coal combined. So the job creation potential of this transition is huge. So that's number one. The second issue is about place. It's about geography. In other words, jobs that are created for renewables or for maintenance of solar panel, or making sure that we take green as the watchword for infrastructure. We move from brown via olive to green. That's a huge amount of job creation potential. In terms of how this impacts the communities dependent, for example, on coal. I mean, look at Arizona. The Navajo Nation have relied upon a coal-fired power station there to generate income for that very vulnerable community over decades. And when that plant was decommissioned, the question is, well, where else do people go? Not just for the jobs, but also for the income that comes through tax revenues to support a whole community. So that leads us back to a very important part of the preamble to the Paris Agreement, which gets forgotten. But the preamble talks about this concept of the just transition, and making sure that transition plans pay attention to the impact on those who are vulnerable. And that means the poor. It means often in the United States, people of color who are being hit harder by the impact of climate change now. So look at the impact flooding, of extreme weather events. It is communities in poverty who are the least prepared and the hardest hit. So we need in the transition both to be thinking about the jobs transition for people out of fossil fuels and into renewables, huge potential, but we also need to be thinking about how we mitigate and manage the risk that's already bringing suffering to vulnerable communities. So I would urge everyone when they're thinking about the transition to go back to that preamble to the Paris Agreement, because all of the ambition for bringing emissions down rests on this concept of the just transition. And in Climate Action 100+, which is an investor initiative which CALP has helped to put into motion, we have made this one of a 10-part net zero benchmark that we've just launched in order that we can start to engage with companies and understand their plans and the impact on the workforce and the community. But if we don't pay attention to that, this transition will be politically unmanageable as well as a cause of great human suffering. So we need to just walk and chew gum, as the Americans say. We need to be able to do more than one thing at the same time.
We did speak earlier with Sarah Bloom Ruskin about the whole importance of the regulatory agenda. We spoke about the somewhat Byzantine approach that America has on financial regulation in general. How does that harmonize with the approach in the not in the United States, in the European Union, where, of course, there's also quite a lot of cumbersome networks and structures and bureaucracy to try to get around. How important is it to have a joined up regulatory approach between America and Europe when you look at standards and disclosure regimes and taxonomy and so on? Sarah put forward the view that is very prevalent in the US, that it's really a market first system and the regulation comes along afterwards. How important is this market led approach? Because after all, you see investors, both the asset owners and the asset managers every day, they seem to have actually taken on the message, don't they?
Well, I think our view at CalPERS is this is not only, but also, to quote the old comedy duo, Peter Cook and Dudley Moore, we need the market to function. You know, Climate Action 100+ is a great example of investors gathering together to overcome their tragedy of the commons, to really pick up their responsibilities. And there's something in the order of well past 50 trillion in investors signed up for that. And it's a global agenda.
You've had a great deal to do with that, haven't you, in the last 3 or 4 years, putting together this huge number of asset owners as well as asset managers.
And managers too. This came out of us looking at we wanted to answer the question, well, how much of these global emissions, how much of this problem do we own? So we did a carbon footprint of our global equity portfolio, which has about 10,000 holdings in it at present. We found that 100 companies or less are responsible for 85% of the emissions. So think about this. 100 companies are the third largest source of emissions on the planet. Number 1, China. Number 2, the United States. Number 3, just 100 companies. So this really presented us an opportunity to work with our fellow fiduciaries and say it's up to us to make sure that we bring the emissions down for this group of companies, because it's going to make a real impact on achieving that net zero goal by 2050. All well and good. Then we've got 2 big problems. The first is the lack of data. When we were modeling this, less than half of the companies provide any data that you can use to make those calculations. And secondly, we know this is one of those show and tell exercises where companies with difficult or absent plans for the transition are not going to be the ones that report. So you get a lot of false positives, and you also don't have the ability to rely on this information because it's not standardized, it's not audited, it doesn't go through the company's internal controls, it's not integrated into the financials. So that means in order for the market to work, we need regulators to pick up their side of the story. And as Sarah says, I agree with her, the market has a powerful role to play. But we absolutely need regulators and policymakers to pick up their side of the bargain.
Is it more than just that, though? You need, in a way, civil society, don't you? You need people who are the pensioners, who are the beneficiaries of the pension funds. Maybe you need journalistic organizations as well to point out where things are going wrong. The regulators can't do everything. And so some of this disclosure has to be enforced, you might say, by civil society, not just by the dead hand of the controller of the currency or whatever.
It's not a dead hand, it's a visible hand. So we have the invisible forces of the market. Thank you, Adam Smith, for that wonderful metaphor, but the visible hand of regulation is essential. It's not the dead hand. We are supportive of regulation because regulation that makes markets work more efficiently is a positive benefit for us. And we're very active in our strategy in calling for the regulation that we think will enable the market to deploy capital for price discovery, for stewardship. All of this we need regulators to do. But you're absolutely right. This isn't something where we've got a little duet between finance and politicians. The choir here is civil society, and civil society sets the expectations for politicians. Civil society is the source of the savings that go into the investment system. So the common wealth upon which the financial markets rely is derived from ordinary working people's savings. So we have this common interest where people are looking at this issue from different points of view, but ultimately there is a shared ambition to make sure that we address this transition. Civil society has a role in people's purchasing power, in their decisions on who they vote in to positions of influence on policy and regulation, but their lifestyle issues are extremely important. So what we decide to do are, eating hamburgers and not checking where the meat is coming from and the connection with deforestation, or when we buy shampoo with palm oil in it, and again, we are not seeing if there is deforestation at the back of producing that palm oil that goes into the shampoo or the margarine or whatever else we're using to make ourselves feel comfortable. All of that has got to be dealt with. So supply chain transparency, you can't get away from that on the regulatory side, but companies have a role, investors have a role, and every single person has a role in terms of how they eat, vote, and travel.
I mean, I take all that absolutely on board, but how happy are you about the state of civil society in the United States right now? I accept this is a slightly philosophical question. You still have 73 million people voting for Mr. Trump. Do you think that the spate of forest fires that you have in California and the snowstorms in Texas are going to be enough to swing people around to this more holistic, more Californian view that you're putting?
Well, it's an important question. In these times of partisanship and political division and the febrile environment in which we are working, there is an absolute premium upon recommitting to truth and balance. And I think in the United States, something that that is becoming a topic of conversation even for investors is looking at the role of private organizations which control the flow of information, which dictate, if you like, the quality of the dialogue. Now, right now, they suggest that they have a role a bit like the post-delivery people. We bring a package or a letter to your door. We have got no responsibility for what's inside. However, if you start to see the impact culturally and in terms of political dialogue and ultimately the impact on democracy and the quality of political discourse, it's not just what is being delivered, but it's accepting that there's a big question now, which is about the social media giants being held to account as publishers. If they do that, it means revisiting an idea about balance, which was lifted from media organizations in the 80s in the United States, and it means revisiting the question of the accountability. So we're seeing voluntary initiatives, for example, by Twitter saying there are huge damage done to people if they're not given facts and science-based information, for example, on the vaccine for managing the pandemic. It's equally the case that if people are being fed information which is not reliable, which is not correct, and which isn't put into some balanced picture, it's very hard for people to know what is right and what is in their best interests. So I think we've got to come back to this bigger question about the role of companies in democracy. And it's also a question about political donations as well. Because in the United States,
we're unraveling lots of issues here. I just wonder whether you think there's enough time given the fact that we'll be on to the midterms before too long, Mr. Biden's only been in office for 6 weeks, this whole nexus of issues that you're talking about here, what does he need to do? Does he need to create a sort of climate czar that people have been talking about in the Treasury? Of course, Sarah Bloom Ruskin couldn't say all that much about that, but she did say the buck stops very much with Janet Yellen. Janet Yellen is the person to enforce this and to give a lead. She's got quite a few other things on her plate. What advice would you give somebody such as yourself, Anne, who's a tireless campaigner for all this, and you've been through many years of this? What advice would you give Janet Yellen in terms of enforcing and implementing a change in the system, which has got much more to do than just mere regulation? It is, as you have said, about the levers of civil society. What advice would you give her?
The most important thing is having a coordinated, a choreographed strategy, because each of the regulators in the United States at federal level has a role. And despite the political partisanship on the topic of climate change, I would urge everyone to take a look at the CFTC report that came out before the election last year, so under the previous administration, acknowledging that climate change is a financial risk. And that has over 50 recommendations addressed to each of the regulatory players. All of that now needs to be coordinated. I would say we don't particularly want to say a climate czar, because things didn't end well for the czars. Maybe we need some other reference to a climate coordinator or a climate choreographer. But each of the main regulatory agencies is looking at this at the moment. And I would also draw attention to an important bill put forward in the Senate by a California senator, actually, that's just a coincidence, Senator Feinstein, which actually sets out a congressional mandate to get a coordinated regulatory response. And that would mean the SEC, it would mean the children in the SEC family, the PCAOB, FASB, and looking at all the different tools of enforcement, of interpretation of accounting standards, for example, which is vital. We need to revisit some basic accounting to make sure it's capturing climate risk. We look at concepts like impairment or amortization. There's lots to do there, the PCAOB as well.
Okay, we'll make sure that's on Secretary Yellen's desk tomorrow morning then. And final question, since I'm going to hand over to my friend Frank in a moment, but to take up your metaphor of the choreography, we've got a worldwide ballet here, but some of the company members are dancing out of tune and sometimes they go to the wrong performance. How are you going to get coordination on a world economic basis between, say, the Americans, the Chinese, and the Europeans? What's your recipe for that in just a couple of minutes, this small subject, Anne?
This small subject. Well, the watchword here is accountability. We've got to make sure that investors are willing and able to ensure that they vote on board appointments and also on auditors, and make sure that climate risk is being properly integrated. And the measure, as I say, we've developed this net zero benchmark, which can be used by anyone to chart what's happening with CapEx, with transition plans, with compensation, with the just transition to make sure workers and communities are being taken care of properly. All of that's there. What we now need is to get over this fear of flying, fear of being a fiduciary, so that investors actually bring forward their ability to ensure that boards are being held accountable. So watch Exxon, because Exxon last year had quite big investors voting against directors, including CalPERS, including BlackRock. And now the debate is, have we got climate competent boards? Now, supervisors also have a role in this. They have a fit and proper test for the boards of banks. So we need to make sure that the boards of banks, so that we've got a huge amount of money about to be rolled over in fossil fuel financing, gives us a 2 to 3 window to make sure that that rollover of debt is being rolled over in a way that is actually consistent with the Paris ambition. So no more talk. Action.
No. Action. Well, this is a huge agenda that you've sketched out for us. It's about accountability, it's about competence, it's about transparency, and it's about will, I would say. And this will, this resolution could be carried forward on a number of different planes. So thank you so much for being with us. This will not be the last time you speak about this with Omfif and the DZ Bank. good luck in all your endeavors. Get all those activists together, make them indeed overcome their fear of flying and their fear of exerting their fiduciary power. Good luck to you, and many thanks for being with us today. Look forward to hearing more messages from you. I'm going to hand back to Frank Scheidig.
Thank you, David. Thank you, everyone.
Thanks, Anne. Thanks, David. That was great. And again, thank you very much for your flexibility to come in, Anne, at that late time. At least here in Frankfurt, it's early in California, I know. And I can't be more than agree with what you said. I mean, what the transition will bring us is such a boost. And many of the leaders of the real economy and financial markets, but particularly in politics, have not yet recognized what this transition period up to 2050 can mean for us globally, and also what it can mean for the non-developed and developing countries. So I hope that you all have got a little bit more color on these 10 hours, what we have digested and finishing right now here. I also like the phrase that the civil society is the ultimate driver of the transition. And social media is as in everything. Meanwhile, if I look to my three boys, I don't know how they would have been risen up before social media kicked in. But obviously I'm from a different generation, but also meanwhile a strong user of it. Yeah, let me wrap up the day a little bit. And we have started indeed with the Asia Pacific Rim in New Zealand, 8 o'clock in the evening time. That was 10 hours ago. Can you imagine? Followed by Australia, Greater China, the other Pacific and Southeast Asian Rim. They all seems to me very much committed to the global sustainable agenda, and where Europe is probably leading at the moment is playing on the whole framework of the SDGs. By the way, if you see the lightning in the background, it's quite funny. In the morning when we started, we had the rising sun, then it started to get foggy and cloudy, and now I have a big thunderstorm in my backyard here, yes, just on a side note. But coming back to Asia Pacific, what they have done obviously is a huge issuance, and we heard that from Dr. Marjun this morning, particularly on the green bond side. But probably one link is missing, is the issuance of the social bond side, particular to shoulder and to finance the pandemic. And this is going to happen here. Europe will be hopefully a good guide to them. I was glad that we had people contributing from the Finnish municipality side and from the EU during this time zone panels. Then we kicked in with the EU into the European bloc. They were Gert-Jan Koopman, Director General of Budget Responsibility. He was referring to the huge programs, SURE for unemployment, how they become the largest social bond issuers from the public sector globally within a short period of time, and what they will do and how they will finance the EU on their rescue and recovery fund called Next Generation EU. Having said that, we had a good discussion with the promotional banks in Europe. I will not mention everyone, but very well-known names. There came a lot of good referrals to what they have done in the past, when they have started. We then hand over to the US. I was very impressed by the talk given from the treasurer of the World Bank, Jingdong Hua, who was referring to how the World Bank Group is going to help, in particular, the developing countries in this pandemic time, but also in the outlook going forward. And this was a very strong focus on the sustainable agenda. And then we end up with a great panel here, managed and moderated by Denai, Thanks again very much for your contribution and also to the panelists. And then finally, we end there where the sun has just risen up in California. Thanks to Calpers, thanks to Ann Simpson. I liked very much what she all was referring to and speaking to. I would like to add one point to what Ann said. It is also important that the money which has been risen and which will be risen over time from these public sector institutions goes to the right investor base. And we avoid investors and to give them any material if they just want to use it for speculation. I do hope that we all together help them. We from the Z Bank definitely do so, and I can imagine many others in markets will follow our path here. And yeah, then let me just refer a little bit to the generations. We do that all, and SDG is a common language which doesn't know any borders, where we can talk to each other and use this time of transition towards to a carbon-free year of 2050. I'm really looking forward and have learned today under the phrase shifting the trillions. And I'm full of hope that we will shift the trillions in the right way of having also a sustainable tomorrow secured for our coming and future generations, means also our kids. Thank you very much for that. A big thank goes obviously to our partners, Nada Maleki and the Maleki Group, Omfif and the SPI Institute, David Marsh, John Orchard and colleagues. I also thank very much our asset manager, Union Investment, and not to forgotten our great partners here, Morningstar and Deloitte. It was my pleasure to enjoy the past 10 hours with you on this true global agenda on one day. I believe that was an inaugural one. It will be not the last one. I can already announce that we plan to have something similar and at least with the same quality before the summer break kicks in. So please stay in contact with us. I'm very much looking forward hearing from you, and feedback is very much appreciated because we're always learning. And if you have missed something or you have a clap on the shoulder for good things we have done, thank you very much for giving us the feedback. And I wish you always and now a safe, sound evening and a deep sleep and a good sunny tomorrow. Thank you very much. Goodbye.